really hard to predict. I do think the economy is weakening. We're seeing, evidence of that in some of our companies. You're seeing, I have some concerns. There's been a huge subsidy in terms of low interest rates, and most companies fix their rates or their debt at very low rates, and certainly real estate investors did the same. And that works until it doesn't work. And so I think what's going to be interesting is to see what happens when people have to reprice their debt. And I think that can have sort of a cliff-like effect. And you're certainly seeing that in real estate.
In the ever-evolving landscape of the economy, signals of potential challenges often come from influential figures. Recently, billionaire investor Bill Ackman, founder and CEO of Pershing Square, a highly esteemed firm on Wall Street, issued a dire warning about the future of the real estate market and the broader economy. In this detailed exploration, we'll dissect Ackman's concerns, analyze the factors at play, and assess the potential repercussions on the economy. Ackman's warning. Ackman's warning revolves around the looming threat of a tsunami of real estate bankruptcies. With the potential to account for hundreds of billions of dollars, this economic storm could send massive ripples throughout various sectors. Let's delve into Ackman's insights and understand the key factors contributing to his apprehensions. Economic weakening. Ackman acknowledges a general consensus in the United States that a recession has been avoided for the near future, with the belief in a so-called soft landing. However, he expresses his reservations, citing evidence of economic weakening, especially within some of the companies Pershing Square monitors. His concerns stem from the substantial subsidy provided by low interest rates, benefiting both companies and real estate investors. While this has been advantageous, Ackman foresees challenges when businesses and investors face the necessity of refinancing their debt. Interest rate dynamics. To comprehend Ackman's concerns, we must examine the dynamics of interest rates, particularly in the context of commercial real estate loans. Unlike residential mortgages, which are often fixed for the entire loan duration, commercial property loans reset their interest rates every few years. This flexibility exposes commercial property owners to the risks associated with interest rate fluctuations. Commercial real estate loan scenario. Let's illustrate the potential challenges with a hypothetical scenario. Consider an individual, John, who invests in a small apartment building for $1 million, financing $800,000 through a loan. If John secures a 3% interest-only loan, his annual debt payment is $24,000, comfortably covered by the property's net operating income, NOI, of $50,000. However, if interest rates increase to 6% or 9%, the debt payments rise to $48,000 and $72,000, respectively, creating a precarious situation where the property might incur losses. The real estate cliff. Ackman points to a hypothetical cliff facing the real estate market, driven by the estimated $1.5 trillion worth of commercial real estate loans coming due between now and 2025. This potential cliff represents a critical juncture where the impact of interest rate resets could lead to widespread financial distress. Perspective from Pershing Square. Bill Ackman's perspective is not that of a passive observer. As the head of Pershing Square, overseeing $10 billion in investor funds, Ackman is deeply entrenched in the world of finance. He emphasizes the importance of understanding the Federal Reserve's Fed role in shaping the future economic landscape. Fed's dilemma. According to Ackman, the market anticipates a Fed interest rate cut in the coming year. The timing of this decision is crucial, as it could have political implications. Ackman acknowledges the debate within financial circles about the Fed's potential actions and their consequences. The dilemma lies in whether the Fed will cut rates to stimulate the economy or delay the decision due to political considerations. The domino effect. The real concern, as highlighted by Ackman, is the potential domino effect triggered by the increasing real interest rates. As inflation declines, the real rate of interest rises, impacting the economy negatively. Ackman suggests that maintaining rates in the middle fives could have a retarding effect on the economy. The risk of a hard landing becomes more pronounced if the Fed delays cutting rates, potentially leading to a recession. Corporate debt challenge. Beyond the real estate market, Ackman draws attention to another significant challenge: corporate debt. Morgan Stanley estimates that nearly $2.6 trillion in corporate debt is coming due over the next 3 years. The rolling over of this debt, at higher interest rates, poses a substantial challenge for businesses, potentially leading to a wave of corporate bankruptcies. Zombie companies. Approximately 10% of U.S. publicly traded companies are labeled as zombie companies, heavily burdened by debt and barely able to cover their financial obligations. The impending increase in interest rates could push these companies into insolvency, with severe consequences for the broader economy. Coca-Cola's illustrative example. To underscore the impact of higher interest rates, a simple thought experiment involving Coca-Cola's $34 billion long-term debt is presented. The illustration demonstrates how even a modest increase in interest rates can significantly elevate annual interest expenses, affecting the company's profitability and limiting resources available for growth. Conclusion. In conclusion, Bill Ackman's warning serves as a crucial alert for investors and policymakers. The challenges posed by rising interest rates, coupled with the substantial debt burden across various sectors, create a complex economic landscape. The decisions of the Federal Reserve in the coming months will play a pivotal role in determining whether the economy faces a smooth landing or navigates through a turbulent period marked by real estate and corporate debt challenges. As we navigate these unprecedented times, the prudent investor remains vigilant, understanding the intricacies of the financial ecosystem and adapting strategies accordingly.